Paying taxes is optional. Let me repeat that because I know your brain is fighting the concept right now. You have been trained, conditioned, and educated to believe that taxes are as inevitable as death. But for a very specific group of people, the people whose portfolios look like the GDP of a small country, taxes are not a requirement. They are a penalty. They are a fine you pay for not reading the rule book. If you are paying 30, 40, or 50% of your income to the government, it is not because the system is broken. It is because you are playing the wrong game. You are playing checkers, while the ultra-wealthy are playing three-dimensional chess. I have spent the last decade tearing apart the financial filings of the elite. I look at the ledgers that make no sense to the average person, and I see the same pattern over and over again. It is a three-step dance that turns billions of dollars of lifestyle into $0 of taxable income. They call it buy, borrow, die. And today, we are going to deconstruct this machine. We are going to take it apart, gear by gear, so you can see exactly how the engine works. This isn't about evasion. This isn't about offshore accounts in Panama or hiding cash in a mattress. This is about the American tax code functioning exactly as it was written. The story begins with a lie you were told in school. The lie is simple. Make money, pay tax. If you work a job, you trade your time for money. You get a paycheck. And before that money even hits your bank account, the government takes a bite. You are a W-2 earner. You are the battery that powers the system. The government loves you because you are easy to track. Every dollar you earn is reported. You have zero maneuverability. You are trapped in the income tax bracket. But the wealthy do not earn income. This is the first key to the mystery. Income is the most heavily taxed thing in the universe. If you earn a salary of $1 million, the IRS is going to take nearly $400,000 of it, just like that, gone. So, rule number one of the rich: do not have an income. Jeff Bezos, Elon Musk, Warren Buffett. Go look at their tax returns when ProPublica leaks them. Their salaries are tiny, sometimes $1, sometimes roughly $80,000. Why? Because they know that income is for suckers. Instead of income, they focus on step one of the strategy: buy. They buy assets, specifically assets that appreciate. Let's imagine a character. Let's call him Victor. Victor is worth $100 million. But Victor does not keep $100 million in a savings account. If you keep cash in a bank, you are losing money every second. Inflation is eating you alive. You are bleeding value. Victor is smart. Victor puts his money into things: stocks, real estate, art, commercial buildings. Let's say Victor buys $10 million worth of stock in a tech company. 10 years pass. The company explodes. That stock is now worth $100 million. Now, pay attention. This is where the matrix glitches for the average person. Victor has made a profit of $90 million. But has he paid any tax? The answer is zero. Because in the eyes of the tax code, nothing has happened. This is called unrealized gains. It is paper wealth. The number on the screen went up, but until Victor sells that stock, the IRS cannot touch him. He is sitting on a mountain of gold, and the tax man is standing at the bottom of the mountain, waiting for an avalanche that never comes. The average person looks at this and says, well, sure, he's rich on paper, but he can't eat paper. To buy a yacht, to buy a mansion, to buy dinner, he has to sell the stock, and when he sells, he pays tax. That is the logic of the middle class. That is the logic of the poor. And it is completely wrong. This brings us to the second, most critical step of the strategy, the step that allows the rich to live like kings while paying less tax than their secretaries. Borrow. Victor wants to buy a $20 million penthouse in Manhattan. He has the wealth. It is locked in his stock. If he sells $20 million worth of stock, he triggers a taxable event. He would have to pay capital gains tax, let's say federal and state taxes combined to roughly 30%. If he sells $20 million of stock, he has to write a check to the government for $6 million. $6 million. Gone. Vaporized. Victor does not want to lose $6 million. Victor hates losing money. So instead of selling, Victor walks into the private wealth division of a major bank. JP Morgan, Goldman Sachs, it doesn't matter. They all have the same menu for clients like him. He puts his stock portfolio on the table. He says, "I have $100 million in Amazon stock. I want a loan." The banker smiles. The banker loves this. This is the safest loan in the world. It is a secured line of credit, or in the real estate world, a cash-out refinance. The bank says, "Okay, Victor, we will lend you $20 million cash, and we will use your stock portfolio as collateral. If you don't pay us back, we keep the stock. But since you are good for it, here is the cash." Now, watch the magic. Victor receives $20 million in his bank account. Is a loan taxable income? No. Read the tax code. Go to the IRS website right now. Loans are not income. Loans are debt. You do not pay tax on debt. In fact, acquiring debt is a non-event for the tax collector. So Victor just got $20 million of spending power. Step 1, complete. He buys the penthouse. He pays 0 taxes on the $20 million. But wait, I can hear the skeptics screaming. But he has to pay interest. The bank isn't a charity. You are right. The bank charges interest. But let's look at the math. This is where the high interest rate narrative falls apart for the ultra-wealthy. When you borrow money on a credit card, you pay 20% interest. When you get a mortgage, maybe you pay 6 or 7%. When you have $100 million in collateral, you don't pay retail rates. You pay the SOFR rates plus a tiny spread. Let's say the interest rate is 3 or 4%. Victor is paying maybe 3% interest on his loan. Compare that to the alternative. Option A, sell the stock, pay 30% tax immediately, lose 30% of your capital forever. Option B, keep the stock, pay 3% interest per year. It is simple math. 3% is smaller than 30%. But it gets even better. Because Victor did not sell his stock, the stock is still his. It is still sitting in his account. And guess what? The stock market, on average, goes up by 8 to 10% a year. So, while Victor is paying 3% interest to the bank, his asset is growing by 8%. He is making a 5% profit by borrowing money to buy a house. This is the arbitrage of the elite. They use the bank's money to live, while their own money stays invested, compounding, growing, expanding. They never interrupt the compounding process. Einstein called compound interest the 8th wonder of the world. The rich know that the tax man is the interruption of that wonder, so they never sell. They just borrow. They borrow for the house. They borrow for the private jet. They borrow for the lifestyle. They stack loan on top of loan. And you might think, this sounds dangerous. What if the market crashes? What if the bank calls the loan? That is a risk. But when you have $1 billion, you are diversified. You are not borrowing against one volatile crypto coin. You are borrowing against a diversified portfolio of blue-chip assets. The bank will lend you maybe 50% of the value. The market would have to drop 50% instantly for there to be a problem. And if that happens, the world is ending anyway, so nobody cares about your tax bill. But there is a final problem. Eventually, the loan must be paid back. Eventually, the bill comes due. Or does it? This brings us to the third and final step. The step that makes this entire strategy not just clever, but practically immortal. Die. It sounds morbid, but in the world of high finance, death is just another taxable event, or rather, a tax avoidance event. Let's go back to Victor. Victor lives a long, happy life. He spent 40 years borrowing against his assets. He lived like a king. He never sold a single share of stock. He accumulated, say, $50 million in debt. But his assets grew from $100 million to $500 million. Now Victor dies. His estate passes to his heir. Let's call him Junior. Junior inherits the stock portfolio worth $500 million. And he inherits the $50 million debt to the bank. Now, under normal rules, if Junior sold that stock, he would have to pay tax on the profit. Remember, Victor bought the stock for $10 million. It is now worth $500 million. That is $490 million of profit. If Junior sold it, he would owe roughly $150 million in taxes. But here is the loophole. Here is the glitch in the simulation. It is called step-up in basis. Section 1014 of the Internal Revenue Code. When someone dies, the value of their assets is stepped up to the current market value. The IRS forgets the original price. The IRS forgets that Victor bought the stock for $10 million. As far as the IRS is concerned, Junior acquired the stock on the day Victor died, at the price of $500 million. The cost basis resets. If Junior sells the stock 5 minutes after the funeral for $500 million, his profit is zero. $500 million, sale price, minus $500 million, stepped up basis, equals zero. Tax due, $0. Junior sells a portion of the stock. He pays off the $50 million loan to the bank. He keeps the remaining $450 million. Free and clear. The capital gains tax that accumulated over 40 years, wiped out, vanished, erased from existence. Victor paid zero tax while alive because he borrowed. Junior paid zero tax on the inheritance gain because of the step-up in basis. The government gets nothing. This is the buy, borrow, die strategy. It is legal. It is standard practice. Every single family office in New York, London, and Singapore uses this. If you have a net worth over $50 million and you are not doing this, your accountant should be fired for malpractice. Now I want to contrast this with the reality you live in. The work, save, pay strategy. Let's look at Tim. Tim is a successful doctor. He makes $300,000 a year. He feels rich. He drives a Mercedes. He lives in a nice suburb. Tim works 80 hours a week. The hospital pays him $300,000. The IRS takes roughly $90,000 immediately in income tax. Social Security and Medicare take another chunk. Tim is left with maybe $180,000. Tim wants to buy a house. He has to save up his after-tax money. He is saving dollars that have already been taxed. Tim invests in the stock market. He buys Tesla stock. It goes up. He gets excited. He sells it to pay for his kids' college tuition. Boom. Capital gains tax. He pays again. Tim dies. He leaves his savings to his kids. If his estate is large enough, though currently the limit is very high, there might be estate taxes. But generally, Tim has spent his whole life bleeding money to the system at every transaction point. The difference between Victor and Tim is not just the amount of money they have. It is the direction of the flow. Tim's money flows through the income filter. Victor's money flows through the asset filter. Income is taxed at the highest rates. Assets are taxed at the lowest rates, or deferred indefinitely. This is why you often hear wealthy people say, "I take a $1 salary." Mark Zuckerberg, Jack Dorsey, the guys running the world. Do you think they are doing it out of altruism? Do you think they are being noble? "Oh, keep the money, I don't need a salary." No, they are avoiding the trap. Taking a salary is the most tax-inefficient thing you can do. If Zuckerberg took a $100 million salary, he would pay $37 million to the federal government, plus California state tax. He would lose half his money. But if he takes stock options, if he takes equity, he enters the realm of capital gains. He enters the realm of buy, borrow, die. Let's dig deeper into the borrow part, because this is where the misconception lies. People are afraid of debt. You have been taught that debt is bad. Dave Ramsey told me to cut up my credit cards. And for the poor and the middle class, Dave Ramsey is right. Consumer debt is cancer. Using a credit card with 25% interest to buy a TV that loses value the moment you open the box is financial suicide. That is bad debt. But the rich use good debt. Good debt is debt that someone else pays, or debt that allows you to access tax-free liquidity. Let's look at real estate. This is the cousin of the stock strategy. Robert owns an apartment complex. It makes him money every month from rent. But Robert doesn't pay tax on that rent. Why? Because of a magical word called depreciation. The government allows Robert to pretend that his building is falling apart. The tax code says, "Hey, Robert, buildings wear out over 27 and a half years. So every year, you can deduct a portion of the building's value from your income." The building isn't actually falling apart. In fact, it is going up in value. But on paper, Robert tells the IRS he is losing money due to wear and tear. This paper loss cancels out his rental income. So Robert collects $1 million in rent. He deducts expenses. He deducts mortgage interest. He deducts depreciation. His taxable income is zero. He has $1 million cash in his pocket, but his tax return shows a loss. Then Robert wants to buy a boat. Does he sell the building? No. That would trigger tax. He goes to the bank. "Refinance my building." The bank gives him a loan for $5 million against the building's equity. Tax-free cash. He buys the boat. Do you see the pattern? It is always the same. Acquire an asset, never sell the asset, borrow against the asset, die, and reset the clock. This strategy is why the statistics on wealth inequality are so skewed. The media talks about the income gap. They say, CEOs make 300 times more than workers. They are missing the point. The income gap is a distraction. The real game is the asset gap. The wealthy don't care about income inequality. They care about asset accumulation. While you are fighting for a 5% raise at your job, which will just push you into a higher tax bracket and get eaten by inflation, they are acquiring assets that compound tax-free. So, what is the lesson here? I am not telling you to go out and commit tax fraud. I am not a financial advisor, and I am certainly not your lawyer. But I am telling you to stop looking at money like a consumer and start looking at it like a capitalist. The tax code was not written to punish you. It was written to incentivize certain behaviors. The government wants jobs, so it gives tax breaks to business owners. The government wants housing, so it gives tax breaks to real estate investors. The government wants energy independence, so it gives tax breaks to oil and gas drillers. The government does not need you to watch Netflix and save cash in a checking account, so it does not give tax breaks for that. When you pay taxes, you are essentially paying a fine for doing things the government doesn't care about. If you are a W-2 employee, you are solving a problem for your boss, not for the economy at large, so you pay the highest rate. But if you become an investor, if you become an owner, you align yourself with the incentives of the system. You might be thinking, this is great for billionaires, but I don't have $100 million. I can't walk into JP Morgan and ask for a $10 million line of credit. You are right. You can't. Not yet. But the principles scale down. You can stop hoarding cash and start buying assets. You can use a HELOC, home equity line of credit, to access liquidity from your house instead of selling it. You can hold stocks for the long term instead of day trading and triggering short-term capital gains tax. You can look into real estate investing where depreciation can shelter your income. The mindset shift is the most important part. Stop trying to increase your income. Start trying to increase your net worth. Income is what you report to the IRS. Net worth is what you use to get a loan. The buy, borrow, die strategy is simply the most extreme, optimized version of the rules. It highlights the fundamental truth of the American financial system. It is designed for owners, not for workers. When you understand this, the anger you feel when reading headlines about billionaires paying zero tax changes. It shifts from anger to understanding. You realize they aren't cheating. They are just reading the instructions on the box, while everyone else is trying to assemble the furniture without looking at the manual. Let's address the elephant in the room. Is this fair? From a societal standpoint, you could argue it's terrible. It concentrates wealth. It creates dynasties. It prevents the circulation of capital through taxation. But from a mechanical standpoint, it is flawless. And until Congress changes the laws regarding step-up in basis or starts taxing unrealized gains, which is a logistical nightmare and likely unconstitutional, this is the game. The politicians know it. They use it too. You think the senators and congresspeople are keeping their wealth in savings accounts? Please. They are doing the exact same thing. So, don't hate the player. And honestly, don't even hate the game. Just learn the rules. Because while you are sitting there worrying about your tax refund check, waiting for that tiny kickback from the government, the elites are borrowing another $50 million against their portfolio to buy an island. And they are doing it with a smile, knowing that the loan isn't income and the bill won't come due until they are 6 feet under. And even then, their kids will wipe the slate clean. That is the power of buy, borrow, die. It is the ultimate financial cheat code. And now, you know how it works. The question is, are you going to keep playing the game of income, or are you going to start playing the game of assets? The choice is yours. But remember, the clock is ticking, and inflation is waiting.